Yeah, okay. So the landlords, one of the benefits of being a landlord is that no self-employment tax for landlords. So if you make a if you're self-employed and you don't have a employer, uh, and and you have to pay the self-employment tax, you have to pay 15%, 7.5% Social Security, 7.5% on the employer side. You have to pay both sides. And then, of course, you have to pay the regular income tax and everything else on it too. Landlords, we don't have that. And that is a very plus to owning a rental. So if you make $10,000 commission on real estate, then the $10,000 commission on real estate, you have to pay $1,500 uh, Social Security and Medicare tax. But if you have a $10,000 rental income, you don't have that. So that's one of the good things about being a landlord, is the tax wise. Okay. So this is the one. If you have losses from passive activities, such as owning rental property, okay, you have limitation on uh, amount of deductions that you can make. So if you be considered passive investor activity and you experience a loss, you have to carry over that loss for large. It depends how big it is. So you have to carry over until it's done. So you still have to report a part of it, but after a certain amount, you cannot deduct. You just have to move it forward. Okay. So we talked about that. Okay. So that was on the. So what kind of things you can deduct from your taxes? Loss from theft or yep, you can. Uh, you have to if you lose something to some thieves losing it, then yeah, you can write it off. But if your insurance company reimburse you, you have to report that as an offset. So on a tax return, the way it's going to look is like rental income, $10,000. I got rental income $10,000. Somebody stole all the copper of my house, $5,000, minus 5,000 for that, and then insurance company reimbursed me $3,000. So you need to add that $3,000 in it. Uh, the insurance companies, this is one of the most common one that I see, that the the landlord, one of my landlords had a major fire. But the insurance company paid him $140,000 to repair that property. And he spent around $125,000 repairing that property. So when it came to his income tax doing it, he deducted the $120,000 repair he did, but he failed to report how much his reimbursement was that the insurance company received. Um, and somehow I think the Internal Revenue Service is becoming more. Oh, I'm sorry. Let me close this door, please. Sorry, this area is becoming more and more. So basically, what happened to him was that I think Internal Revenue Service technology is changing, especially in the 1099 1099 reporting and comparing the 1099 to the tax returns. So he did receive a letter that it says that there's a discrepancy and he should check with his tax preparer and then report the underreported revenues. And then when he talked to CPA, they say, okay, and then he end up refiling. He didn't get audited or fined or anything like that, but he received that warning. Okay, property depreciation, you can deduct it. It's 27 and a half years on certain properties. Certain things you can deduct on the year that do the work. And certain things you have to deduct it up to 27 and a half years. And certain things like the price of the land, you never can deduct it. So it depends what component of the property it is. And you can deduct it anywhere from 1 year, same year. Like if you change the faucet, is considered repair right now. If you change the roof, maybe 20 years, a refrigerator, maybe 7 years, a furnace, like 8 years, things like this, you get to depreciate it, and that gives you a certain amount of deduction every year. You can do, it will go away in 3 years, but 3 more years of we have is called uh, uh, cost segregation study. So it was they did it so you get to they give you some incentive to spend more money on your real estate and rental properties to boost the economy. So on uh, certain circumstances, if the property improvements are less than 7 years, you get to deduct all of it this year. No, not all of it, 60% of it this year. Because they're phasing it out, so each year is 20% less. That can give you a great way of reducing your tax burden by accelerating your depreciation. But two of my landlords I already know that their CPA or their tax preparers, they told them they're not familiar with it, they're not advising it. But you should, if you have spent large sums of money last year, I'm not talking about a few $100 here and there, those you just got to do a straight depreciation or a few thousand. But if you, for example, you spent 80, $100,000 on a property, many components of it, because they're called capital improvements, you cannot write them off on the first year. Under normal depreciation, property depreciation, either you're going to do a 7 years up to 27 years, but under this cost segregation, you get to do it this year. So if your CPA doesn't understand that, the math is not that difficult, and there is some companies for the larger ones for the fee, they will do that cost segregation study for you, and you get to have more write-off this year. Okay. Okay, so the next one is repairs and maintenance. Of course, we all know if you have a leaky faucet, we can deduct it. Okay. Segmented depreciation. This is getting technical now, but you can deduct certain segments in a accelerated than the other ones. Utilities, of course, you can. Closing costs. So when you purchase a property, not owner-occupied properties, investment properties, you can deduct certain closing costs on the year of the purchase. And the only way you get to deduct it on the tax return is to have a correct scheduled report when you purchase the property. So the closing costs, certain parts of it can be deducted. Mortgage insurance, PMIs, MIPs, and all of that can be done. Legal forms can be done. Tax deduction for landlords, questionable, uh, questionable home office, real estate related travel, meals, phones, tablets, computers, phone services, as an individual landlord. So as an individual landlord, you can, there's a form that you need to complete. There's a part of the IRS form. It's part of the tax form. This is how much you collected, what is your depreciation, things like that. At the bottom, it says other. That other cannot be 100% of your remaining income. I don't think it should be. I have an escrow operation, so I don't have a home office, but I do have a, what do you call it? I do have a office space that we do write off. Uh, uh, Real estate related travel, I do that on a continuing education. I try to take us someplace very warm and inviting. Okay, meals, maybe not. The phone, tablets, computer, phone services, minimally, within reason.